Principles of Finance Chapter 2 Understanding Financial Statements and Analysis.
Financial statements communicate a company's financial health. In other words, they show how well the company is performing financially. Different groups rely on these statements for different purposes. Managers use them for planning and control, things like setting budgets, monitoring costs, and deciding on future growth strategies. Investors look at them to make investment decisions, understanding profits, growth potential, and risks. Creditors, such as banks or suppliers, use them to decide whether to provide loans or credit, checking if the company can repay. Regulators and government agencies review them for compliance and tax purposes, ensuring that rules are followed and correct taxes are paid. That's why accuracy and transparency are critical. When financial statements are reliable and clear, trust is built, and everyone, from managers to investors, can make confident decisions. Businesses rely on four main financial statements, each with a unique role. The income statement shows revenues, expenses, and net income, revealing profit or loss over time. The balance sheet provides a snapshot of assets, liabilities, and equity at a specific date. The cash flow statement tracks cash inflows and outflows from operating, investing, and financing activities. The statement of changes in equity explains movements in owner's equity during the period. Together, they offer a clear picture of a company's financial health and help stakeholders make informed decisions. The income statement measures a company's profitability. It's based on a simple formula: revenues minus expenses equals net income. It highlights key items like sales, cost of goods sold, operating expenses, taxes, and net profit. This statement helps us assess how efficiently the company is operating and track profit trends over time. The balance sheet shows what a company owns and owes. It follows the accounting equation: assets equal liabilities plus equity. It lists current and non-current assets and liabilities, helping us understand liquidity, solvency, and the company's overall capital structure. The cash flow statement tracks the actual movement of cash in a company. It's divided into three sections: operating activities, which cover day-to-day operations; investing activities, which include buying or selling assets; and financing activities, such as loans, equity, or dividends. It helps evaluate liquidity and how effectively a company manages its cash. Financial ratio analysis turns raw financial numbers into meaningful insights. Ratios fall into four main categories. Liquidity ratios, like the current and quick ratio, show a company's ability to meet short-term obligations. Profitability ratios, such as net margin, ROA, and ROE, measure how well the company generates profits. Leverage ratios, like debt to equity and interest coverage, assess financial risk and use of debt. Efficiency ratios, including inventory turnover and asset utilization, indicate how effectively resources are managed. These ratios are most useful when compared over time, against competitors, or against industry standards. Different groups use financial statements in different ways. Management uses them for budgeting, planning expansion, and controlling costs. Investors look at them to decide whether to buy, hold, or sell shares. Creditors rely on them when deciding to grant or deny loans and to set interest rates. Government and tax authorities use them to calculate taxes and ensure compliance with laws. And the public may use them to evaluate a company's contribution to the economy. While financial statements provide valuable insights, they have limitations. They're based on historical data, so they don't show current market conditions or future performance. They often rely on accounting estimates and judgment, which can reduce accuracy. They don't capture non-financial factors like brand value, employee skills, or market reputation that also affect a company's success. And finally, differences in accounting methods can make comparisons between companies less reliable.